Here we have the Profitable Member Strategies trading forecast for week 3. The company that we'll be looking at today is Kratos Defense and Security Solutions, stock ticker KTOS. For this stock, I have an upside price target of $27. In relation to the market's current prices, this relates to or coincides with upside potential coming in at roughly 36.88%. Here we can see on the price chart that the stock has taken a bit of a dip recently, which does suggest that we're getting a bit of a better price on the stock currently. We have seen some recent earnings figures from this company. They were actually reported last week. If we were to drill in on this chart a little bit, and I will do that in the technical analysis portion of this video, but as we can see here, there is a bit of a spike lower here and then a reversal higher. This is because the company did perform better than expected last quarter, and the company's earnings results were better than the consensus expectations. So we are starting to see a bit of a bounce here. And at these lower levels, I do feel that we're getting a fairly good discount on the stock given its operational efficiencies and the fundamental outlook for the company. For a little bit of background on Kratos Defense, we can see that the company operates as a technology company that addresses the defense, national security, and commercial markets. So essentially, this means that they work with both government clients and commercial clients. The company operates through two segments: Kratos Government Solutions and Unmanned Systems. Here we've got a little bit more of an in-depth look at what exactly the company produces. I won't go through and read all of this. If you're interested in taking a look at these specific products, this would be a good time to pause the video and read this product line that the company has available. Kratos primarily serves as national security-related agencies, the U.S. Department of Defense, intelligence agencies, and classified agencies, international government agencies, and commercial customers. Kratos Defense and Security Solutions was incorporated in 1994, and its headquarters is in San Diego, California. Next, we'll take a look at some of the company fundamentals because there is a lot to like about this company. They recently became profitable, so it does look like we're at a bit of a turning point here as far as the operational efficiency is concerned. Key fundamentals. The company recently reported earnings, as I said, and they recently reached operational profitability. This is somewhat rare in the small cap space. You will occasionally find stocks that are associated with companies that are profitable. For the most part, small cap companies are not profitable. They have not yet reached that status. Here, we are dealing with a company that has just now reached into, it's just sort of gotten its head above water, so to speak. And we are starting to see a bit of a turning point here as far as the broader outlook. The company also recently beat consensus expectations for quarterly results. Earnings per share surpassed market expectations by a massive 384%. This was a massive earnings beat that the company just posted. And overall, the valuation metrics are quite attractive in relation to its peer group. So in particular, we could point to a company like Palantir Technologies. I am a fan of Palantir. I do think that is a great company with a positive future. However, this company here that we're looking at today is flying under the radar a bit more, and as a result, some of its valuation metrics are more attractive compared to these other more well-known companies. Here we can see a bit of the past price history and performance of the share price itself. Overall, we do have a relatively strong uptrend here for at least for a small cap company would be concerned. This is a stable uptrend. However, within that uptrend, we're starting to see a bit of a decline, a bit of a dip recently that is now reaching a turning point given the fact that the stock has recently posted strong earnings results. I'll take a closer look at this chart in the technical analysis segment of this video. As I said previously, the KTOS share price target from my view currently comes in at $27, which indicates upside potential of roughly 37%. In terms of volatility, as we know, small cap stocks tend to be more volatile than larger cap stocks. Traditionally, historically, it's of course not always the case, but much more often than not, that is the case. But here we can see a small cap stock that has extremely low levels of volatility, not only within the defense industry, but within the broader market as a whole. So we can see here in this chart, which shows that overall the defense industry tends to be more stable than other aspects of the market and even the broader averages within the market. But price volatility in KTOS has only been 4%, which is even superior relative to its peer group and relative to its industry. So this does make the stock a bit safer in terms of what is traditionally seen within the small cap space. Some of the other stocks, like last week, I did post a video about a biotech stock. Those tend to be more volatile. So what I wanted to do with this stock pick was kind of offer a bit of a more conservative small cap stock with a huge amount of growth potential, but limited downside. So the key metric that we'll be looking at with this stock is the price to sales ratio. The company has recently become profitable, but overall the revenues are still somewhat limited. This is a small cap stock that's somewhat earlier in its history and in its career as far as its introduction to the broader market is concerned. So for this stock, we will be looking at the price to sales ratio for a relative valuation analysis. Currently, the price to sales ratio for the stock comes in at 2.6. Here we have a look at the historical. This is actually price to sales. I made a mistake on this slide here. It does say it in some of the sentence here. This is not the price to book ratio. This is the price to sales ratio. But the relative idea here is the same. We are trading on the lower end of the spectrum as far as the company's historic price to sales ratio is concerned. So we're still getting a good value in terms of this valuation metric. Taking a closer look at the Q2 earnings report that was just released, here we can see that the company did beat expectations by a fairly wide margin. Earnings per share came in just above 5 cents per share. And this is significant because during the year prior period, we saw losses of 2.2 cents. Revenues came in just above 300 million, which represents an increase of 17% on an annualized basis. Net income came in at nearly $8 million, which is up by 10.8 million relative from the figures that were reported during the same period last year. Profit margins headed into positive territory here at 2.6%, which is an improvement from the net loss that was seen during the year prior period, the year Q2 2023. So this move into profitability, which is new, and this is one of the main reasons that we're looking at this stock. This move into profitability was primarily driven by higher revenue figures. Here we have a bit more analysis on the recent earnings report. Revenues exceeded analyst expectations by 8.7%. Earnings per share also beat analyst estimates. Currently, the company is forecasting revenue figures to grow by 8.5% over the next 3 years. This does perform well. This is almost 4 times greater than the aerospace and defense industry as a whole, which is currently expected to grow by 2.6%. So within this space, for anybody that's interested in gaining exposure to the aerospace and defense industry, this is a company that could perform nearly 4 times better in terms of growth over the next 3 years. One of the reasons that I chose this stock, I didn't mention this earlier, is just the fact that there's broad geopolitical turmoil that's been increasing over the last few years. I don't think there's much debate about that. I don't think that's a controversial statement to be making. The world does seem to be becoming a more dangerous place. So for anybody that does want exposure to that part of the market, this is another reason that I'm pointing to this stock. Over the last 3 years, on average, the company's share price growth has exceeded its earnings growth rate by 63 percentage points, which is a very significant difference in operational performance. Here we have a look at the prior earnings figures. I could have shown this video last week. We had another company that was going to be heading into an earnings report. I had 2 options here. I went with the potential for the faster growth rate because we're still early on in these trading strategy videos. So I wanted to kind of give somebody, I wanted to give a stock with more punch and potential upside explosion. And we did see that with Iovance Biotherapeutics last week. However, this is a bit more of a conservative stock to choose. I wanted to kind of give a bit of a safer choice here with this week's stock pick. So currently, as we can see here, this is another sea of green. This is a very strong performer in terms of earnings results. So it's really not surprising here that the company was able to beat these earnings figures once again. As we can see here, there is a very strong history. We can go back all the way to the early parts of 2022. We do not see any downside earnings misses here. So this does give the company strong prospects in terms of holding on to the stock. If you do buy this stock and you hold on to it for a while, even into the next earnings release, of course, this does not mean that the company will not perform as expected. We could see an earnings miss here, but what I'm saying is that something like that would be extremely abnormal. What we've seen historically with this company is a very strong series of earnings beats, and overall this trend is expected to continue. I mean, we've got some very strong numbers here. We've got a beat of 300%, 120%, the most recent beat. was much stronger than average expectations. So this company is on very strong footing here, and there really isn't much question about that when we look at the historical performances. Here we have the current earnings and revenue growth forecasts for the company. This top line here, this top blue line is the revenue figure, and then the lower kind of teal green line would be the earnings figure. With these charts, it's a little bit difficult to see this because they look very flat in comparison. But if you kind of drill in here a bit, you can see that the earnings figure is now crossing into positive territory. So that's sort of a main catalyst here that I'm looking at, and one reason why I'm picking this stock currently. We have just crossed over into this territory, so I do believe that the stock is going to start to get much more attention from the broader market. Here we have the earnings figures relative to the broader market. KTOS earnings rate is showing growth rates of 37.3% on an annualized basis, and this is expected to grow much faster than the broader market, which is expected to grow below 15%. So here we can see some very significant differences in the annual earnings growth, which is more important than revenue growth. Here we can see the earnings per share EPS growth forecasts over a more long-term time horizon. As we can see here, there is a very strong upward trajectory, and anybody that enters into the stock position right around now is going to be entering in right on the ground floor as far as profitability is concerned. The company recently became profitable, and shareholders that are getting in now are likely to see most of the benefit from that. Here we have the financial position analysis. So we're looking at the short-term liabilities and long-term liabilities. Here we can see that the company's short-term assets far exceeded short-term liabilities, and the same is true from a longer-term perspective. This blue bar on the bar chart here is much larger than the liability section, which is the light green or teal color. From a debt to equity perspective, I do have a chart here in the following slide, but there's a lot of information here, so I wanted to sort of explain it in two different slides. So the debt, well, I can just show it kind of quickly here, but this is the price chart here. So I'll kind of go back on the slide here and explain what this means exactly. So the current debt level, KTOS has more cash than its total debt. In addition to that, the company is showing very strong performances in terms of reducing its debt. The debt to equity ratio has fallen from 51.2% to 14.3% over the past 5 years. That's a significant difference, and it does sort of lend validity or credence to the current turnaround point in profitability. As far as debt coverage is concerned, KTOS debt is well covered by its operating cash flow at a rate of 34.5%, and then interest coverage on its debt payments. KTOS interest payments on its debt are well covered by earnings before interest and taxes, or EBIT, at a rate of 3.4. So here we can sort of see that in this chart. As we can see, the company had seen, more problematic debt levels earlier in its history, roughly 2017 and earlier. But we can see a turning point here that is starting to unfold, and the equity part of this ratio is accelerating quite rapidly as the debt portion is declining. So that's not something you see very often. You don't see a chart that really looks like this very often. Here we have a balance sheet analysis visualization. I will not bore people with the balance sheet itself. That's very boring reading. Nobody really wants to read that. It's basically an Excel spreadsheet. So here we have a visualization of what that actually looks like. As we can see, the company does have some debt at $189.5 million. However, the equity figure far exceeds this, both from a long-term and short-term perspective. Okay, so here we have the current ownership breakdown, which is also quite interesting because as we can see here, 83.2% of the company's stock is owned by institutions. The general public is the ownership there is less than 15%, and then individual investors are just below 2.3%. So what this essentially means is that this is a stock that's really flying under the radar of the market. I could point to companies like Palantir and things like that. Those are, that again, it's a great company, but it's a stock that everybody knows about. This is not true here, but I do think that this is going to start to change here relatively soon, given the fact that we're now bringing our head above water and currently moving into profitability. So currently, we can see that there is a large amount of institutional support that will sort of prevent the stock from falling much lower. This is a huge institutional breakdown here. And as we can see, the individual investment community, it's almost unheard of in that space. Here we have some of the top shareholders here. Here you'll see that Vanguard and BlackRock currently own most of the company. One red figure that you will notice here is ARK Investments. This is obviously Cathie Wood. Some people are huge fans of her. Some people are not. I'm not going to get into the politics of that, whether or not people like or dislike Cathie Wood. But one factor to note here is that she was a seller somewhat recently. However, there is still a huge amount of institutional investment that is supporting this stock. So I don't expect her exit to be particularly problematic, given the broader trends and who actually owns these shares. So in conclusion, Kratos Defense and Security Solutions is redefining warfare with cutting-edge unmanned systems and cybersecurity solutions. The company's next-gen focus and diverse defense portfolio make it a strong contender in the evolving national security landscape. So, for anybody that's interested in gaining some exposure to the defense and security part of the market, anybody that believes that there are geopolitical tensions that are currently increasing, this is a somewhat conservative, non-risky investment option here that is supported by very strong earnings and has recently moved into profitable territory in ways that are not seen in most other small cap stocks or even within the industry itself.